I'm Heather Hopkins, Research Director for the Platforum. I'm joined by Jeremy Fawcett, Head of Direct.
Hello.
We wanted to share with you some findings from our recent direct-to-consumer guide. This is a report that's in its fifth year, and it looks at the direct-to-consumer market, the platforms, consumer view of investing. And Jeremy, this is a hot topic. What are some of the drivers in this market?
Well, there are two huge drivers. One is the internet and how that's enabled people to manage their own investing affairs. And then the other is the regulator, the retail distribution review. And this year we've seen the implementation of the FCA's platform policy rules. But there's a third massive driver that sort of joined the party, which is the pensions freedom. So much more interest in pension savings. We think that will benefit the direct platform market. We expect to see people accumulating money on platforms, but also decumulating it in the retirement phase as well.
We haven't seen the growth that some people were expecting for this market. There was a number of people in the industry that were quite bullish of how this would really shift things in the investing community. What are we seeing in terms of growth of this market?
Yeah, well, so assets on platform as at September 2014 are 132 billion. That's a 13.2% year-on-year growth. So that's below the 20% plus year-on-year growth that we've seen for a number of years. We don't think that's as a result of the new platform rules. We think it's just a reflection of very poor investor sentiment in the second half of 2014. However, the advisor platform market continues to grow at that sort of 20% year-on-year growth level. But I think the important difference here is that there are off-platform assets that advisors are progressively moving onto platforms, and we don't have that same effect in D2C. So we believe that the growth in the market will be transformational, but we think it'll be a generational change rather than something that happens according to dates on the regulator's calendar.
Right, that generational shift was something that we pulled out of this research. I think it's a really interesting point. Jeremy, you mentioned earlier the RDR. One of the impacts that some people were expecting of that was that we'd see the cost of investing falling. Have we seen the cost to the end investor decrease as a result of the RDR?
It has. So two different elements of this. One is the platform fees, which are either fixed price models or percentage of assets. On the percentage of assets model, the cost is now between 0.2% and 0.5%. We would say that the midpoint is 0.35%. Now, if you compare that to what platforms were charging before the retail distribution review, it was probably something like 0.6%. So it's about 1/4% difference. And that makes a difference of £25 for a consumer with a £10,000 portfolio, or £250 a year for a consumer with £100,000. So
right.
Quite significant. And then there's another element as well, which is the fund manager charges, and they've come down to some extent as well. We see platforms like Fidelity Personal Investing negotiating a number of discounts with fund managers, and Hargreaves Lansdown negotiating slightly larger discounts with a smaller number of fund managers. And the effect of that, if you look at a number of popular funds with consumers, on Hargreaves Lansdown, you might be saving about 7 basis points. So again, that's £7 over a year for £10,000 portfolio, or £70 a year for a £100,000 portfolio. So the direction of travel there is definitely on the way down for active funds and also for passives.
Interesting. Savings that can certainly add up in the long term for an investor. And moving forward, how do you expect to see this sector being disrupted in the future?
Well, I think that's interesting, because we think that a lot of the innovation is going to be more corporate than startup. So 2 or 3 years ago, it was all about new brands like Nutmeg and R-Plan, Strawberry Invest. I think over the next year or two, we're going to be looking more closely at fund managers So Schroders have made an investment in Nutmeg. Also, life insurance companies, so Aegon have launched their Retire Ready proposition. And don't forget the banks as well. I think there's a really interesting collection of things that they can bring to the party. So online banking allows people to combine their day-to-day finances with their ongoing savings. Customer acquisition, they've got huge access to customers through their online banking propositions. And also brand. The banks have had a tough time since the financial crisis, but they are extremely trusted custodial brands.
Interesting. Okay, great. Thank you. If you'd like more information on our direct-to-consumer guide, do get in touch. It includes our overview of the size and structure of the market, the asset levels for the different platforms within that market. It includes a rich piece of consumer research looking at routes to market, the perception of investing via platform, and the preferred routes that consumers take to market. And we update that throughout the year. So do get in touch. And we also have a conference coming up this summer on the 24th of June. And we'd love to see some of you there. Thank you very much.